So I think so, definitely. I think if you look at the sectors now that are kind of offering some value to investors, it's somewhat more the defensive sectors. So the likes of utilities, pharmaceuticals, for instance, healthcare, and then on the consumer staples and consumer cyclical side also, there's a lot of value. And if indeed we see interest rate cuts, you should see that eventually feed through to the economy, increased consumer spending, things like this. So you would expect those valuations to reverse if indeed we do see those interest rate decreases.
All right, so you're bullish on utilities before a possible cut. One of the reasons, according to your note, is that the dividend yield is there, and then also as we see rates go down, there's a lower cost of capital, which deeply impacts these companies. But you also like consumer cyclical. You actually say that's the most undervalued sector in Europe, and that's a bit of a head scratcher for me. Seems a bit counterintuitive. Isn't the consumer already stretched? Aren't they already facing higher cost of living?
Absolutely, absolutely. And those high interest rates that we've seen are still feeding through to your mortgage holders. So they're seeing their kind of mortgage bills increase month on month now as the rates finally come through. So you're absolutely right. It's a tough place to be a consumer. You don't have a lot of spare cash to spend, particularly on discretionary items. But that whole situation, if indeed we see decreases in interest rates, should eventually start feeding through. Also, the fact that inflation, we've come off 18-month highs of inflation now, and it's starting to normalize as well. That should lead to lower prices in the supermarkets and things like this. So that should ultimately help the consumer and help those consumer discretionary firms.
Well, I mean, let's get a bit granular. What areas of consumer cyclical are you looking at? I mean, there's a number of areas. And also, as we see consumers more stretched, even with rates easing, they certainly have to pick and choose where they spend that money.
That's absolutely right. That's absolutely right. I think if you look at companies where we see value at the moment, you're looking at the likes of consumer giant Nestle, beer manufacturer Anheuser-Busch, owner of Budweiser, for instance, and then even areas like homebuilders as well, particularly in the UK. They've been beaten up quite badly over the last 6-9 months or so, and they should see a large boost, if not the largest boost, as interest rate decreases finally come through there.
Yeah, specific names always helps, especially for the audience. So I also want to ask you, you're also really focused on valuation. So right now you say the European markets, they're trading at about a 5% premium according to your fair value metrics. I looked at your chart. Now, this was interesting. The last time we saw the markets at this much of a premium to your fair value metrics, it was January, February of 2022. That was right before a big drop in the market. Are we in danger of any type of situation where history may repeat itself?
I think that's always the danger we should be aware of as investors. You don't want to be too blasé going into markets like this. I think what investors are hopeful, though, is that there's economic catalysts, that the European economy, we saw, European GDP, we saw UK GDP as well just today. And those signals, albeit kind of weak, are still positive. They seem to be kind of turning a corner. And I think investors will take a lot of optimism from that. So, yeah, as you said, valuation's slightly overvalued, but I think investors will look at the economic catalysts and be positive from that, I think.
Yeah, as we say that right now, the stocks, the FTSE and the DAX all hitting fresh record highs. I want to talk to you about the other side of this coin. A lot of your thesis depends on rate cuts coming in the ECB sooner than later. Today, we're seeing increased Mideast tensions. We're seeing oil move a bit higher right now. If we don't get those rate cuts, or if oil prices rise, delaying those rate cuts, does that change your thesis dramatically? Does that change the sectors that you see benefiting at least before the cut?
I think it's a matter of timing. So if indeed the rate cuts get pushed out, like we're seeing in the US at the moment, investors were hopeful for rate cuts around about now, and then they're saying, okay, maybe it'll be closer to the end of the year or even 2025. That does kind of cause some dismay for investors and could indeed lead to a sell-off, as you kind of alluded to. I think the situation in Europe is slightly different. The economic situation is weaker, and rate cuts, if you look at economist polls rather for June, it seems pretty nailed on at this stage. And like you mentioned earlier, the Bank of England, those dovish comments yesterday are kind of getting investors hopeful for rate cuts in the UK sooner rather than later also.